Canadian mortgage market is trying to digest the complex and ever-changing economic environment where increasing bank rates, worries about inflation and people's anxiety over potential recession are some of the factors affecting it. All this has put an additional pressure on assets like real estate and stocks because right now Bank of Canada is in a fiscal tightening mode. Now for those who are new to this channel, my name is Sunny and I make content that help a common man financially. So let's dive into today's topic, mortgage rate forecast. Please do like, share and subscribe as that will help boost the YouTube algorithm for my channel, which of course will be highly appreciated. November 2022 job numbers both in Canada and US are out, which do not prove that the economy is slowing down as expected. I understand the real impact of any rate increase could take up to 12 months to trickle down in the economy, but these rapid rate hikes by the central banks in both countries is affecting the mortgage rates, where the idea was to control inflation. Their goal is to bring down inflation to their 2% target while bringing their benchmark rate to more normalized range, not those ultra cheap ones that we saw during pandemic when they were printing money to stimulate the economy. The benchmark for a mortgage rate is Government of Canada's bond yield. This is what government pays on its debt to its investors, which is often considered as the safest investment since they can only default if they go bankrupt. When the market thinks Bank of Canada will increase rates, Canadian government bond yield increases and the bond yield falls in anticipation of a rate decrease. Obviously, Canadian Central Bank makes its benchmark rate decisions based on multiple factors, but this gives you an idea of what the markets are expecting. Experts believe these rate increases will likely create a recession in near to medium term, whereas the markets are pricing 0.5% to 0.75% rate hike in December this year. Inflation has so far exceeded the target 2% rate for several reasons. Coming out of pandemic when we had ultra low rates, the demand outpaced supply, creating global supply chain issues. All this resulted in Canadian annual inflation rate reaching 40-year high of 8.1% in June, which recently has come down slightly. The central bank has to increase in increments their benchmark rate from 0.25% to 3.75% at present, which is their sixth consecutive rate hike since they started raising them in March of 2022. With one more possible rate hike due this year in December, experts are talking about the coming recession in Canada. You could have fixed or a variable interest rate mortgage, both of which have their pros and cons. No doubt, a fixed rate comes with peace of mind, but if you are locked in for 5 years, you might lose in case the rate drops in the next 3 to 4 years. And in that case, opting for 2 to 3 year fixed rate could give you that flexibility where you can renew to a lower rate in case bank rate starts to go south. Now, if you have a variable rate mortgage, when the benchmark rates are on the rise, you will face the heat until the trend gets reversed, which is hard to predict. Once the central bank starts to actually lower its benchmark rate, the variable rate mortgage holders will be happy once again. Nobody has a crystal ball who can predict mortgage rates correctly going forward because there are numerous moving pieces in the economy that can affect central bank's calculation. For sure, we are going to see increasing rates until Bank of Canada could see inflation coming closer down to their target rate. Since there is a lag between the monetary policy and the actual effect on the ground, so there is a fear that they might raise the rates more aggressively, which might bring a deep recession. No doubt a recession is coming, whether mild or deep, which will kill demand and bring supply in sync with it. When that time comes, the central bank will have to lower the rates to stimulate the economy and prop up the demand, which in my limited wisdom will be closer to 2024. But that is me, I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor, so please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.